I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, welcome to Financially Speaking with Jeff Bush. My name is Steve Jablonski. I'm the host today. And as usual, we have a very interesting topic and one that everybody has or has questions about in life, and that is different types of insurances. And before we get into that, I'd like to welcome Jeff.
Well, hello, Steve. Welcome to the show. Great to be here today in our Pottstown offices, high atop the Security Trust building on a corner of High and Hanover Street. We've been doing this show now for 10 years. We were just talking before we started to roll the tape. It's been quite a run, Steve, over the past 10 years, and I know you've been doing it for 6 or 7 of those years. So, yeah, it's been great, and here we are again today. And today we're going to talk. What are we going to talk about today? Life insurance.
Different insurances. Yep.
Okay.
Jeff, before we get into that, I know we haven't touched on this, but we started something here about a month ago to really help the community get educated on around retirement, and it's a lab that we're doing. Why don't we just, if you can, touch on that a little bit?
Yeah. So it's our mission has always been to educate, hence the name Informed Family. And what we started to do is these retirement design labs, and so it's kind of like taking the show on the road. So we do these shows in the studio, but here we're out, in the community doing live events. And we do them in various locations where we have our offices. So we've done them down in Norristown. This coming month, we're doing them up in Allentown at Cedar Crest College. We'll be doing them in Reading in a couple weeks at the Wyomissing Library. So we really move around. But the concept behind the Retirement Design Lab is it's really like a workshop where we dig really, really deep into a lot of topics that are really pertinent when you come to designing a good retirement plan.
Yes, and it's good too because the first lab deals a lot about people's emotions and really coming up with a retirement vision. And then the second one is more of the laws and things like that.
Yeah, and then the third one we call office hours, where the people have an opportunity to come into our office, meet directly with an advisor on our team, and really dig deep into specifics about these individual retirement plans. And retirement planning is a highly individualized process, and we treat it that way. So we don't treat everybody's retirement plan the same. So that office hours is really gives everybody a chance to to dig deep into the individual phase of the plan.
Good.
Yeah, and Steve, while we're on that topic, we should also mention, if you're interested in attending one of these retirement design labs, contact our office. We have the information up on the screen. You can either call us or send us an email for more information on the retirement design lab.
Good. Well, good. Well, let's get into the meat of this. And the one slide there has all the different types of insurances. And not only is there life and health, and there's property, and there's auto. The list goes on, and it can become quite confusing. So let's tackle a few of them and see if we can help out with some of it.
Okay. Yeah, well, it can be confusing. As people start to contemplate retirement, the first thing is Medicare, which is a government program which kicks in when you turn 65, and then there's all sorts of Medicare supplements. And I want to mention that that's not something specifically that we do because it is highly specialized. So we refer that business out to people that are really competent in that field of insurance. But some of the other insurances that we do cover in our practice, we're gonna talk about those today.
Okay. Well, why don't we get started with one of the simplest forms of life insurance?
Yeah. So when you look at life insurance in its most basic form, you have term life insurance. And as the name would imply, it insures you for a term, a specific term. And it can be a 1-year term, or it can be a 10-year or a 15-year or a 20-year. We've even seen plans go out as far as 30 years if you're young enough. But basically what that does is it insures you for that period of time. So let's use the example that you have a 20-year term program. You're going to pay one price. It's going to pay a death benefit if you die, and the most important element here with term insurance is that it builds no cash value.
And a lot of times they compare it to when you rent an apartment.
Yeah. So
And why do you rent an apartment?
Yeah. So if you're talking about if you want to use that analogy to renting a home versus renting an apartment versus buying a home, when you're buying term insurance, it's like you're renting insurance, so to speak. It's not you're not building any equity. You're not building any cash value. You're going to pay that premium for the period of the time or the term, and after that, there's going to be no insurance. And typically, the use for this is there's really two main applications of term insurance. One is with young people that have a lot of debt and a lot of obligations. It's really a cheap way to cover the life of really a major breadwinner that if we had the loss of that life, it would really be a financial burden to the loved ones left behind. So especially if there's a big mortgage, there's a loss of income, the term insurance is a good application there. And also we see it a lot tied to employment.
Yep.
So there's term insurance that comes with a job. So they'll insure the person for maybe 1 times their salary or 1.5 times their salary, and that's generally a benefit that's provided by the company, and it's a benefit of working.
And before we get into permanent insurance, let's talk a little bit about a conversion of term.
Oftentimes what happens with these term policies, there's a conversion feature. So what is a conversion feature? That means that you can convert, if you will, the term policy or the term insurance into some type of permanent insurance. That really comes into play if there's a health issue, because when you do the conversion, there's no proof of insurability. So let's give an example here. So let's say you have a 20-year term policy, and there's a conversion feature on the term policy. And maybe 15 years in, the person that's insured develops a health problem, and a health problem that could significantly impact how the rating would be on a new policy. But because there's a conversion feature, you can now buy a permanent type of a policy at the same rate that you had when you bought the initial term policy.
And I'm actually going through that right now with a client where there was
Yeah, why don't you talk about
there was
this?
well, the term is both almost 20 years old, and it's husband and wife, and he's since had a heart attack and is on a lot of medication, and we go into underwriting, and it's just as they were. He's standard as it was 15, 16 years ago, and she's preferred. So it really, that's a great case when someone does have a health problem, and that's not even considered. It goes back to the original underwriting.
Yeah,
Yep.
yeah. I mean, that's a lot of times, that you don't even think about that when you buy the original term policy, that, there's a conversion feature.
Because
in
some
there.
don't.
Some don't.
Yes.
Yeah, some
and so
companies don't.
this client went from maybe not getting it because of his present health conditions to going back to where it was 15, 20 years ago. So,
Yeah, that's a good feature.
Yep. Let's get into some permanent insurance at this point.
When you talk about permanent life insurance, there's really a couple of different facets of this to consider. First, let's talk about the different kinds of permanent life insurance. We've got universal life insurance, and then under the universal life umbrella, we've got indexed universal life, and then we've got variable universal life. Okay, then in addition to that, we've got whole life. Okay, so these are all different types of permanent policies, but all of them share the fact that they're building cash value, and they're a permanent type of policy, meaning that you're sustaining the death benefit for the life of holding this policy, as long as you keep paying your premiums. And we have to look at there's certain guaranteed elements of it that that are important to consider when you're buying these permanent policies as well.
Yeah. And so, what are the basic characteristics of whole life?
Well, with whole life, Steve, what you're getting is a policy that you're basically getting dividends from the insurance company. And with these dividends, you have the option to take the dividends as cash. You can use the dividends to buy what they call paid up additions, which allows you to buy more insurance. Or you can just take the dividends to build cash value inside the life insurance policy. But with whole life, and when you compare whole life sometimes to universal life, the premium on a whole life policy may be more expensive. And the reason for that is because the insurance company is really taking more of the risk. So because of that, it makes it a little bit more expensive. And that's why I would say in the more recent past, the universal life products have become more popular.
And in each of these, a couple elements. One is the premium fixed, and the other is the death benefit fixed. So if we start with whole life.
Well, the premium is fixed with a whole life policy, but you can also reduce your premium by using the dividend feature. So you can use, if you're getting a dividend on a whole life policy, you can tell the insurance company to use dividends to reduce your premium. Okay, so let's say your premium is $100. Let's say your premium is $100 a quarter. Okay, and your dividend is $10 a quarter. Well, that $10 can be applied to the $100, and then now you're paying $90 instead of $100. So that's one facet of applying the dividend, and the death benefit is the same.
Yep.
That's not going to change, and you can keep doing that, till you die.
And so we look at universal and variable universal.
Yeah, so with universal, it really comes down to crediting, right? How's the gains or the interest crediting to the account? So it can either be a fixed rate, right? So it can be a fixed interest rate. So that can be based on prevailing interest rate conditions, which until very recently, those interest rates have been very low. But now in the last year, those interest rates have crept up quite a bit. Then you have indexed universal life. And indexed universal life has become very popular because what's happening with an indexed universal life policy is the crediting is based on the performance of the underlying index that you choose. Okay, so let's just say, for example, the S&P 500 index. The crediting inside the universal life policy is going to be predicated on the performance of the S&P 500. Okay, so if the S&P 500 is positive, then you're going to get some type of a performance. So, you're either going to get some of it or all of it,
Yep.
the performance of the index. The important facet of that is that you can't lose money. Okay, unlike the variable universal life, which we're going to get into next, but you can't go down. So it's got the good features of the original universal life, where they're paying an interest rate, right? But you have the opportunity to make more money.
Yep.
Okay. Now the downside of that is if you have a couple bad years, you're not going to make anything. You're going to make zero. But still, it is really an opportunity. Over time, these policies have really performed pretty well. And then if you get into variable universal life, which when I got into the business back in the 90s, just to give a little history perspective here today, variable universal life was extremely popular, especially for the company that I was working for. And the reason for that was the stock market was hot. The stock market was really taking off in the mid to late 90s, if you remember, Steve.
Oh, yeah.
And what happened was, you would buy these variable universal life policies, and I remember which we can't do now, and I'll put that disclaimer out there, but we were illustrating these policies at 12%. 12%. Now in today's market, you couldn't do that.
Right.
In today's environment, you couldn't illustrate a variable universal policy at 12%.
Yeah.
The regulators wouldn't like that, nor would we like it either.
want to do that.
You don't want to show a client that, but that was kind of the reality. But then when the market sort of crashed in the year 2000, that tech bubble, these variable policies, people had to scramble because all these projections that were done at 12%, and then all of a sudden we had a couple negative years in a row, and it was a real problem. So the variable policies are not as popular today as they once were.
And what are the variable accounts? What are they invested in?
They're sub-accounts. They function very similar to mutual funds. So you would look at a portfolio, and it would be just like selecting a mutual fund or selecting a choice in a 401k program. You're going to have bond funds, you're going to have stock funds, and then within stock you're going to have value and growth.
Yep.
You're going to have balanced, all kinds of, I even saw ones, I've seen ones with precious metals in them. So there's really a lot of different types of selection that you can have within a variable policy.
Good. Well, that's it for the life. Well, mostly life insurance. Let's get into insuring one's income.
Yeah. One thing that I want to touch on, Steve, just going back to the life insurance. And I know we're going to talk about long-term care insurance, but a lot of these universal life policies now have long-term care access riders on them. And what that does is it allows you to have long-term care protection without going out and buying long-term care, traditional long-term care insurance. So I'll touch
We'll
more
touch on
on that when we get to long-term
Yep.
care. But as far as disability insurance goes, the disability insurance is really important to protect your ability to work, your function of your job.
Yep.
It's really important for people, like for example, doctors, that are maybe like in a highly skilled area where if you can't, you have maybe a surgeon who can't do surgery anymore.
Yep.
It's really important for them to have disability insurance. Protects their income if they can't work.
And a lot of people don't think of it this way, but if you think of what your biggest asset is, and it's the ability to make a living. So
Yeah.
if you made $100,000 for 30 years, help me with the math, but it seems like it's $3 million.
Yeah.
And that's it's bigger than your house, bigger than your 401k. So disability is very,
Yeah,
very
disability is really big, and there's a lot of occupations, or just thinking about like our jobs, what we do. If we can't work, if we can't do what we're really, what our function is, what our job is, if we can't do that, well then that's a significant loss of income.
And something that some people don't think about is they get disability insurance from their employer. Who pays the premium? Does the employer pay the premium, or do they pay the premium? So if the employer pays the premium, then that disability benefit is taxed. So and if it's taxed at 30%, it's tough for people to live on 70% of their income.
Yeah, and then there's a whole realm of Social Security disability insurance, so qualifying for disability insurance on the open market is a lot different than qualifying for disability insurance through Social Security. But basically, when you qualify for disability through Social Security, in essence what you're doing is the Social Security benefit that you would normally get when you hit retirement age, you're getting when you become disabled.
Yep.
So there's some facets there that are different, but I think the underlying message that we want to put out there today is that if you have questions, or even if you need a second opinion or a second look on this stuff, I mean that's why we're here, to help people through this. But the disability insurance is something that's really often overlooked. When people are looking to budget and where they're going to spend their dollars and their discretionary income, disability insurance is often overlooked, but yet it's extremely important.
Yep. Well, good. Let's move along into the long-term care. And I guess when looking at, as long as we've been in the business, which is 25 plus years, this playing field has changed greatly in long-term care from when it used to be 25 years ago to what it is today.
Yeah, long-term care insurance the game has really changed significantly. And when you think back to the 90s, long-term care, traditional long-term care insurance was really in its infancy.
Yep.
And there were a number of companies out there that were carrying long-term care insurance coverage. But one of the problems, Steve, is these insurance companies didn't know how to price their product. And the reason why they didn't know how to price their product is because they didn't have a lot of history to go on. So they were using projections on how long people were going to live, what their health conditions were going to be, they were guessing at what the probability was of needing care, and also what was the cost of this care going to be. Well, it turns out that they had a lot of problems making those projections. People lived longer than they originally thought. The costs were a lot more than they originally thought. And as a result, they had to raise premiums, which was a very, very, very difficult conversation to have with our clients because, you know, our clients, by that time, they were retired and on fixed income. So when you're retired and on fixed income and you're told that your long-term care insurance premium is going to go up,
Yep.
and these insurance companies weren't raising their rates by 2 or 3%, they were raising them by 20%, 25%. In some cases, we saw where there was going to be like a 40% increase, which they, you know, some of these companies did it over a period of a couple of years, but they were really raising the rates significantly. So what we did is we started to put long-term care access riders on the life insurance. And I touched on this a little bit earlier in the show because now your costs are more predictable, right? So if you need both life insurance and long-term care insurance, you can do it with a life program. So let's say you buy a $250,000 life insurance policy, and it's going to pay you, let's say it's going to pay you 4% a month for a benefit, okay? 4% a month is like $10,000, right? So it's going to pay you $10,000 a month for 25 months. Well, for $10,000 a month, you can cover a significant amount of your long-term care needs, okay? But if you never need the long-term care coverage, then that money stays in the account as a death benefit, okay? So that's really a way, so what that does is two things significant. One is that your costs are now predictable. Mm-hmm. You know that you're not going to get rate increases because as long as you keep paying that premium, the insurance company is not going to raise their rates. The second thing is if you never need the care, you never need long-term care, then what's going to happen is it's simply going to default to a death benefit. So the family is going to get the money. Yep. The family's going to get the money one way or another. They're going to get it while you live in the form of a long-term care benefit or upon death.
Someone's going to benefit.
Someone's going to benefit.
That's really the bottom line with that, because back in the way back, you hoped you never used it.
Yeah, so you pay the premium, you hope you never get sick, and then when you die, you know, it's like you paid for long-term care coverage all those years, and you know, you never used it.
And so we get into the next topic. Insurance takes on different responsibilities. So when you're young, as you said, pay the debt, replace income, but as you get older, it can become a wealth transfer tool.
Yeah. So we're going to talk now about a irrevocable life insurance trust, or an ILIT. And what the ILIT does is it provides for assets to pass to the family, to the heirs, on a tax-free basis. Okay, so this is important if you get into an area where there's estate taxes to be considered. But oftentimes too, with a lot of these plans that we're putting together now, you know, a lot of these retirement assets, there's a significant amount of tax that's attached to those assets as well. So what the ILIT does is, because it's irrevocable, yep, it's owned by someone else other than the people that it's insuring, yep, right? So it's husband and wife might purchase an irrevocable life insurance trust, and it's owned by the trust. Okay, so the trust owns the insurance, and then you would pick trustees. So the trustees could typically be children, mm-hmm, right? So you have adult children that you trust, and they're now the trustees of this life insurance. And it's because they're owning the life insurance outside of the estate, it doesn't create any tax liability to the estate upon death. So if you have got a nice life insurance policy inside there, it can really create tax, it's nice tax benefits, tax-free benefits to the family. So I know it's hard to kind of discuss ILITs in a short time frame with this TV show. So I would just say, if that's something that you're really interested in talking about, we do offer free consultations to anybody that watches our show, and you can just reach out and call us or email us, and we can give you a second opinion or maybe a first opinion on irrevocable life insurance trusts or any other thing, anything else that we discussed today on insurance. But boy, Steve, the time really flew today. You were worried about us getting through all or not having enough material here to get through the show, but we really did that, and some more to discuss. But in any event, we're going to sign off today. It was a good show, Steve. Good material on insurance. Always good to talk about that. So until next time, this is Financially Speaking.